So here's a question for you. Where do banks keep their wealth? Well, according to the Federal Deposit Insurance Corporation, roughly 3,800 banks own more than $190 billion in cash value life insurance. This is a huge portion of their Tier 1 safe capital. For example, Bank of America has $22 billion in cash value life insurance. That's more than all of their real estate combined. Citibank has $6 billion in cash value insurance. It's its single largest asset. It has less than $5 billion in other assets. JP Morgan has $11 billion in cash value life insurance and around $11 billion in other assets. Wells Fargo, similarly, $19.3 billion. So these are giant numbers. And of course, bankers are not eager to tell you this. Why do banks have so much cash value life insurance? What do they know that we don't? Well, banks are required by regulators, certainly, to keep large amounts of cash on hand to meet a bunch of unexpected obligations. This is their cash cushion. It has to be unassailable. Banks are able to access this cash immediately, and they cannot put their Tier 1 capital at risk. This is the Tier 1 capital. So by law, banks have to keep a percentage of assets in Tier 1 capital. Using cash value life insurance is such an attractive asset, the Federal Reserve has to make sure to put a limit on how much cash value insurance banks are even allowed to buy. So currently, banks are only allowed to keep a maximum of 25% of their Tier 1 capital in cash value life insurance. Banks buy all the cash value policies they are allowed to buy. So consider this. Think about this. When an economic disaster is coming and when 9,000 banks went bankrupt in the Great Depression, but only less than 2% of life insurance assets were impaired in any way. Similarly, in 2007 and 2008, 450 banks went bankrupt, and again, less than 1% of life insurance companies' assets were impaired in any way. So again, banks are allowed to buy all the life insurance they're allowed to buy. But what about you? Is this a good tool for an individual? If you're not a mega corporation or even a mom and pop credit union, should you still consider whole life insurance as a place to park your cash? Well, even for individuals, it allows us to leave a legacy that lets us spend our money now. Think about that. If you have a reserve fund that's automatically replaced when you pass away, doesn't that give you permission to spend more money, your own retirement funds or cash savings for yourself while you're still alive? So it leaves a legacy later and it lets you spend money now. In addition, there's also a regular parking space for savings. This gives you the ability to regularly drop money, whether it's through your monthly paycheck or through commissions or bonus or inventory windfalls or some sort of business profit that you make. It's a place to park your regular savings for future needs. And by the way, that parking spot is a liquid, accessible cash value. The money in your policy, the cash value portion of your policy, is always accessible and liquid for any reason. In addition, we're able to pull, because we built it a very specific way, we're designing this policy for maximum cash accumulation and less so the commissions or the death benefit. This leads us to giving our clients 8 to 40 times more cash value than you'd have otherwise, just based on how we design the policies. This allows you to use the policy as a financial management tool right from the start. In addition, it allows you, since it is guaranteed, to give you access to money without it stopping the compounding. This is a big deal. This means the cash value continues to grow even when you're using it. This is so profoundly important that it bears repeating. This is, and again, why banks buy so much of this cash value insurance. So let's talk about what it means to have your money continue to grow even while you're using it. And imagine a horizontal line representing net zero going across your lifetime. So when you own nothing and you owe nothing, you are on the net zero horizon, you might say. But what do you do if you need to get into a new vehicle today and you have nothing saved? What's the only way you're going to make that purchase? That's right, you got to have to go into debt. And then you make monthly payments, climbing your way up a staircase of sorts, climbing your way back up to net zero, only to fall down below net zero, again, that horizon line, to buy your next car or send your next kid to college. And then you climb your way out of that as well. Now, some people think it's better just to save money in a cash savings account or a brokerage account. Saving that money into the savings account earns you a little interest. But what happens as soon as you spend the money? That's right, it's gone forever. And you can only start earning interest again slowly as you save up for the next purchase, only to crash again. We refer to this as the sugar high of finance. But what if you could lift off from net zero? What if you could build compound wealth every single day of every single month of every single year for the rest of your life, and you'd never break compounding? Wouldn't you have a lot more money, and you'd always be away from the horizontal line of net zero? Now, some folks say, well, that's great, Mark, to compound every dollar I ever make. But I got to buy cars. I got to buy student loans. I got to buy an education. I got to invest in my business, whatever. Well, accessing the loan feature against these policies allows your money to continue to earn interest even as you borrow against it as if there was no loan. This means you get uninterrupted compounding along the way, even while you have liquid access to the money. Let me say this another way. Imagine a single dollar in your pocket at the end of the month. That's a dollar that you didn't spend at the grocery store or on business expenses. We'll call that discretionary income. So that $1 for, let's say, a 45-year-old, he has a choice. He can either spend that dollar, or he can put it into the Bank on Yourself designed whole life policy with something called a paid up additions rider. Putting that paid up additions dollar into the policy means it will grow consistently and predictably, even with guarantees built in. Let's say this individual who's 45 years old today, when he makes that $1 deposit, lives to be 90 years old. That dollar would then grow, again with predictability and guarantees built in, up to $9, with dividends on top, which dividends are not guaranteed, but they've paid a dividend every year for over 100 years, these companies that I work with. Now, what happens if you don't put in the dollar? Well, you don't have $9. Again, uninterrupted compounding only works if you can save that money and not spend it. And some folks get frustrated because they say, well, Mark, I can put that dollar in and I want that $9 later, but I still need to access the dollar for things in life. Okay, well, there's something called a policy loan, which allows you to borrow against the policy and then pay it back. Let's say it took you 5 years to borrow that dollar out and then pay it back over 5 years. Let's say the loan interest rate at that time was 5%. That means the interest was a charge of 13 cents to borrow that $1 and then pay it back on your terms over 5 years. Let's say that you didn't just do this once, but you did it twice, you did it a third time, and you even did it a fourth time. Each time the borrowing and paying back cost you 13 cents. That's a grand total of 52 cents to borrow that $1 all throughout your lifetime. Now remember, the cash value continued to earn interest and grew even on the capital you borrowed, such that your cash value grew to $9 over your lifetime. Now you did spend 52 cents, buying those cars or whatever it was you bought with that dollar. And so you still have $8.48 remaining at the end of your lifetime. Now, here's my question. If you had a plan and your own financial system, and for every dollar you put into that system, even borrowing that dollar and paying it back with interest 4 times over your lifetime, you still ended up with a net $8.48. How many dollars would you want to put in there? I'll give you a second to think about it. It's not that hard. That's right, as many as you could. Guys, the truth is there's no such thing as paying too much premium.